All right, welcome back to 0.5%, episode 12. This is part 3. I feel like I tried to rush through the end of part 2 because I was coming up on 15 minutes. And I want to recap real quick these last couple questions that I asked in ChatGPT. So we had left off on, my question was, based on Trump's previous presidency and historically the sectors that perform best during increased tariffs, which sector ETF has the most indicators to perform best over the next 4 years? And it says, based on historical trends during periods of increased tariffs, such as during President Trump's term, sectors that benefit most tend to be those focused on domestic production and raw materials. For example, tariffs often bolster materials and industrials, defensive sectors, and two commonly tracked sector ETFs that capture these trends are the Materials Select Sector Spider Fund, ticker symbol XLB, and Industrial Select Sector Spider Fund, XLI. XLB says this ETF covers companies in the materials sector, including key industrial inputs like steel and chemicals. Historical data suggests that when tariffs favor domestic production, these material sectors can benefit as companies gain pricing power and improved margins. XLI, this ETF focuses on the industrial sector, which includes companies involved in manufacturing, construction, and related activities. This sector often sees gains when tariffs protect domestic industries. All right. So I think it said, I think it's trying to cover its ass by saying, however, it's important to note that past performance during tariff increases doesn't guarantee future results. Other economic factors, such as changes in global trade dynamics, technological advances, shifts in monetary policy, will also play a role and should be included into the analysis. So I told it, include those other economic factors in the analysis and to your hypothesis. And it says, all right, well, when considering historical trends during these periods, materials and industrials, defensive sectors, other key factors are global trade dynamics such as shifts in trade policies, changes in the international trade agreement, or retaliatory measures could alter the competitive landscape. For example, if trading partners adopt more protectionist measures, it might benefit domestic producers even further, supporting sectors like materials and industrials. Second one, supply chain adjustments. Companies might diversify supply chains, impacting costs and competitive advantages. This could either enhance or dampen the benefits seen in the sectors historically boosted by tariffs. All right, so that's global trade dynamics. The second one is technological advances. There's 3 of them here. So the first one is automation and efficiency gains. Advances in manufacturing technology and automation can improve productivity for industrial companies, potentially offsetting any adverse cost impacts from tariffs. Second one is innovation in materials. New materials and production methods can lead to higher margins or even disrupt traditional industries, affecting ETFs like XLB in unexpected ways. The third one is digital transformation. Increased use of technology and operations might change the cost structure and competitive dynamics within these sectors. All right, so another economic factor to consider is the shifts in monetary policy. These include interest rate fluctuations and inflation management. This is what we read or saw all throughout previous times of trying to deal with inflation and tariffs. I think we read through it in part 1 or 2. But interest rate fluctuations. Changes in interest rates can influence borrowing costs and investment decisions. For example, lower rates might spur expansion into industrial sectors, while higher rates could compress margins. For inflation management, central banks' efforts to control inflation or unexpected inflationary pressures can affect consumer demand and industrial input costs. Monetary easing might favor industrial expansion, whereas tightening could slow down growth. I think that's what's happening right now. We're just trying to slow down growth. As we saw on the chart in QQQ, like since 2020, this growth has just been not natural. It may become natural, but as much as, or for as long as it's been doing that, relative to how long I can go back on QQQ, movements like this need to be corrected, and usually the sooner the better, or else it's more severe, like we've seen in these last couple of days. All right, back to ChatGPT. Where were we? So, I think that's what's happening. Well, what was the word they used earlier? Jawboning. Nothing to do with the dog. That's hilarious. All right, yeah. So I think it's just jawboning right now. Trying to slow down growth. That's my opinion about what's happening. I mean, inflation is bad. They got to fix that somehow. And I don't think anybody's going to believe a logical method of fixing inflation. So maybe we just scare the public into fixing it. It kind of sucks, but that's my thought on that. I want to jump back into FinViz now. So there's a couple of things that I've noticed on here that are pretty interesting. Let's go to the home tab. I want to see. This is the market, so we could just see it was a bloodbath on Friday. The only few things that were up were consumer cyclical, Nike footwear, accessories, residential construction, and some apparel like Lulu. That's super ironic that Lulu is up when in tariffs on China are up. I don't know if y'all know the story behind Lulu, but it's pretty funny. So this is where I want to come over to. So we are looking at the S&P 500. That's Standard & Poor's 500 index stocks categorized by sectors and industries. The size represents market cap. So you know our biggest companies here: Microsoft, Apple, Nvidia, Google. Man, I remember when Nvidia was a much smaller square. That's insane. But I see these tabs over here. So map, filter, we can go from the S&P 500 and let's take a look at the world. The whole world was down Friday, which is insane to think about if that's really the impact of Trump's tariffs. So most of these countries, I believe, are retaliating, putting tariffs back onto the U.S., but are they putting more tariffs between themselves and other countries too? That's something our news doesn't talk about. I don't know if tariffs went out from the U.S. to all of these countries. All I ever hear about is China and Canada and Mexico. But yeah, the whole world was down Friday. That's just crazy to think about. So then another one we got full. I think this just combines everything. But one that I thought was really interesting was this exchange traded funds. So this is where it's at. So SOX. This is my favorite semiconductor ETF. You can see how big it is, how much part of the technology market it is. I've always loved being in SOX, but for the first time since I ever bought into it, I sold my entire position 2 days ago. I'll show you why probably on Yahoo Finance. But look, the only things that are up are shorting ETF or inverse ETFs. We have SOX S, the volatility, VIX, inverse markets, and then crypto is up. And coincidentally, I'm going to try to do a weekend research video on crypto, in particular one called Avalanche. Someone asked me to look into that. Just kind of excited to do some research on crypto in general. So I'm not too familiar with Avalanche, but I was debating trading it once just on some technical indicators, and it would be nice to know a little bit more about it before trying to trade it. Not something I would ever hold long just because I don't know anything about it, but maybe after doing the research, that'll change. We'll see. All right, so I thought this was interesting. If we want to go, this is 1 day performance. Let's keep it on ETFs. Let's check out 1 week performance. Still the same? Did anything change? One day? Okay, so crypto changed. Crypto just came up. But in the week, it's been normal. But for the week, yeah, everything's down. For the month, everything's down or just chill. 3 month. So I think this is pretty much Trump's presidency so far. Market's gone down. Which, yeah, I'm not worried about. Like, this is going to be the perfect time to get ready to go long when I put back in the money on those ETFs. And then simultaneously going long, trading U.S. companies that are going up, or maybe just sticking with Nugget and Dust ETF. I think prime time is coming. And I've taken some losses recently with my trades that I think are the result of two things. One, me not knowing what I'm doing. Yeah, that's probably the biggest. But the second is, I mean, look at the market. Like, I was trying to trade into a market that is just going down. So the opportunities were not as frequent, not far and few between, but not close and as frequent. I don't know somewhere in the middle there. But yeah, those are my thoughts there. I think, where are we at? 12 minutes. I think part 2 is a little bit longer, so I'll cut this one off here, and then I want to jump into ETFs on Yahoo Finance next. I'll show you the ETFs I'm interested in, like SOX, just the NASDAQ, QQQ, and we'll pick up from there. Thanks for watching.